Hey, everybody. Hope everybody's having a great week. Just a quick reminder for all those that are new to the group, please go check out the Facebook group. Go into the guides section, look at all the past guides. There's past videos on there for past sessions that may interest you that you may have missed. You can also go out, if you can't find them on the Facebook group page, you can also go to the RetireWise YouTube channel, and they're all posted under the Christian Families playlist there as well. So you can find all those. We've talked about a lot of things so far, from budgeting to investments to retirement, emergency funds, debt management, a lot of great topics. Tonight, we're going to talk about insurance and kind of a couple different types of insurance, some best practices and ins and outs, and why it's important. And I'm kind of talking the gamut. There's some types of insurance that are a lot more critical than others, and some that can actually play into retirement planning, applying to your financial goals, your financial planning, all that. But at the end of the day, insurance is one of those things that not a lot of us like to pay, but you sure are happy when you have it. And it's a protection. You got to protect your assets. You got to protect the things that you have. Otherwise, remember we talked about emergency funds. If you don't have the right kind of insurance, then your emergency funds become even more critical, and that your emergency funds have to actually be even larger to cover all that. Now, there's certain insurances you have to have, like auto and home insurance, those kind of things, but there's some other ones that you want to consider and having the right balance of them. So how does that play into we've been talking about on our treasure target, right? So this kind of fits into, or definitely fits into the grow side, where you may say, well, how the heck does insurance fall into the grow? Well, maintain margin is a key word there. And it also gets into the saving for living expenses and emergency funds. Like I just said, if you don't have the right proper levels of insurance, then you're going to be dipping into emergency funds. You're going to be dipping into having more debt to cover those things that insurance could have covered for you, right? And some of it's just safety nets. Protect your assets, protect on what could go wrong, so you can invest in what could go right. Right? Great little saying I like. So we're talking about maintaining margin in the emergency funds and not getting an extra debt, and that's where the insurance really comes into play. So I'm going to remove that here and just kind of talk about what we're like focusing on. So let's start with the basics, right? Let's start with the really basic things of auto, home. Those are the things that are kind of more mandated, right? So you have to have home insurance, right? So with your home insurance, your mortgage company is going to make you have insurance. If you don't have a mortgage, technically you don't have to have home insurance, right? But if something ever happened to your home, you don't have any coverage. So obviously that's going to protect you from, fires, all kinds of different perils, and damage that can come from natural disasters. It depends on what kind of insurance you have. I'm going to kind of come back to the overall what types you need here in just a minute, and I'll group it together with the auto insurance. So on the auto insurance, obviously the government makes you have insurance at the law, right? And a lot of people try to get away with having just the bare minimums of coverage, which is not what you want to do. The state minimum coverage, like I'm going to use Georgia for example, the state minimum coverage in Georgia does not even cover the cost of most vehicles that are driving on the road. If you look around, how many cars do you see that are 30, 40, 50, 60, $70,000? And if you have the bare minimum of what the state requires, your insurance policy is not even going to cover enough to pay that off. And guess what? Then you're going to be stuck with paying the difference. If you don't have the money, then they're going to try to sue you, right? So speak with a good agent. You got to have the proper coverages. And those coverages actually that's not the expensive part. There's some of the liability coverages. You want to make sure you have the proper liability coverages so you don't get stuck holding the bag and be in a devastating spot. That could be, we talked about emergency funds and things that you would need an emergency fund for. Well, if you end up getting sued, or you ended up having to pay out a huge difference between what your policy pays out and what the other parties do, then you're going to be in a bad spot, and you're probably going to have to be dipping in those emergency funds or taking on debt, right? So you want to have the right liability limits. You want to have the right coverage for property damage, those kind of things for auto, and obviously have the right kind of service with the the right agency. So the other side of that, because you want to have someone that you can rely on, someone you can talk to, that's local, that you can just go to. On the homeowner's side, now the mortgage companies are going to dictate how much the minimums you're going to have, just like on auto, but they're usually pretty close because they want to be able to ensure the proper value of your home. Because if something happens, their money is lent to you, and they need to be able to have that house be rebuilt. It's not only to your advantage, it's to their advantage, because they'd be stuck holding the bag, right? But you want to check that value at least yearly, right? It's a great idea to do a yearly review of your insurance policies. And on the homeowner side, house values increase. That can go down, but they increase as well. You may not have the right proper coverage, because if you have replacement coverage, that means what is it going to take to replace that house, right? Rebuild that house. So if you took your insurance out many, many years ago and that property value has gone up, the cost of everything has gone up, you may not have the right value placed on your home as far as coverage goes to cover the replacement value, right? Now you can save different amounts on your premiums by choosing different, deductible amounts. A lot of insurance companies go by a percentage, but you can choose a flat rate. But there is liability coverages on your homeowners as well. Make sure you're properly covered there in case someone gets hurt, at your house, right? All right. So homeowners of property is called property and casualty. Very basic, that everybody's going to have for your home. And if you don't own a home, then you want to get renter's insurance. If you're living in an apartment or you're renting a home, you've got to have renter's insurance to protect yourself, because if something happens to your belongings that are in that house, now you're not insuring the building that you're living in, but if there was a fire or a natural disaster or theft, those kind of things, the renter, the person that owned the home, who you're renting it from, is not responsible for that, for your property that gets damaged or stolen. You have to have your own policies, and rental policies are extremely, extremely cheap. So look into that if you're renting a property. You don't want to get stuck without having any coverage at all. So that's renters. That's kind of your living and your car. And of course, if you have boats and campers and all those kind of things, you want to make sure those are properly insured as well. So of course, one of the other sides of insurance is health insurance, disability insurance. There's a lot of different options out there. Most people are covered through their work. If you don't have health insurance through your work, then you can go out to the marketplace that the government puts out there, or any third-party private insurance. But there's some good options out there. You just got to choose and investigate what the right options are for your family as far as deductible levels go, what the premiums are, what the doctor's networks. One thing that really consider, though, is there's it's called a HSA, a health savings account. You're able to open those up if you have a high deductible health insurance policy, right? Now, the high deductible term may scare some people off, but it's really advantageous, especially if you don't go to a doctor a ton. But even then, it's valuable. The only way you can open up an HSA, a health savings account, is if you have a high deductible plan. I'm going to talk about why that HSA is important here in a second. But basically, a high deductible plan gives you much lower premiums, right? So your premiums are lower than a standard like PPO plan. You have a little bit higher deductibles. But the health savings account, if you have a high deductible plan, enables you to put money into that HSA. If you're working for an employer that offers that, they usually put in a portion as well. You can build that money up. And unlike a flexible spending account that comes with, traditional plans, you don't have to spend that money every year. On the flexible spending accounts that are tied to those traditional health policies, you have to get rid of that money at the end of the year, or you lose it. On the HSA, you can save it and roll it over and keep it building up. The great thing about that is you put money into it tax-free, and you get to take the money out tax-free for using it for health benefits, right? But this is a great savings tool because you can continue to build it up. And as you get older in age, you get to later on in your years, in your retirement, you need more medical attention, and you have more out-of-pocket expenses for medical. You can tap into your HSA. If you get most HSAs, or a significant amount of them, if you get a good HSA, once you get to a certain dollar value in your account, and it's different for different types of HSA accounts, is you can actually take that money and invest it into an investment fund. So you can have a portion of your balance for medical expenses. You can have a portion go into investments. You're making that money grow for you. It's growing tax-free, tax-deferred. You still get to take that money out tax-free later on, using it for health in medical. And that health and medical, it's not just it's doctor's appointments, but it's for premiums later on. It's for copays. It's all those kind of things. Very, very, very advantageous. It's like a double or triple tax advantage because you're putting in it pre-savings, or excuse me, pre-tax, taking it out pre-tax, and it's growing tax-free, right? It's phenomenal. That's actually, if people have HSAs, I know a lot of people that have an HSA and they still pay their copays out of pocket and let that HSA grow and save it for when they have bigger medical expenses or for when they're in retirement or later on in life when they have greater needs. So look into that if you can. If it's available to you, it's a great option. Premiums are lower and you get that HSA account. All right, so that's the health. And also when you get later on in life, you're going to have Medicare. You got to file once you reach retirement age. There's Medicare Advantage plans that's run by private companies, and then you got the standard original Medicare that's run by the government. Each have their pros and cons to it. Highly recommend you talk to a specialist in regards to which is right for you. There's a lot of even local people that will help you with those choices. If you don't have anybody, let me know. I have a couple different partners that I work with that I can refer you to that will help you make the decision that's right for you as far as Medicare goes. There's a lot of ins and outs there. All right, so that's how, along with health insurance, things that's related is disability insurance. Well, what happens if you get in an accident and you're disabled and you can't work anymore? Some companies offer that as part of your compensation package, or it can be added on. It's extremely inexpensive, and that's something you want to look into as well, because if you all of a sudden you're unemployed and you can't work, then your disability is going to pay you a percentage, typically around 60, sometimes 70%. You're normally about 60% for long-term disability of what you're originally making. So that enables you to not have to dip into those emergency funds or go into debt more if you have those disability insurance policies. Like I said, a lot of employers offer those as a group, kind of a group policy. They're extremely inexpensive. So you want to take advantage of that as well. Right. So that's all those things are helping protect your assets, helping protect you, helping protect your home, and protecting you from financial catastrophic disaster. So while you may not like to pay for insurance premiums because you think, well, it's just, I'm just throwing money away, I'm not getting anything for it. Well, you can't buy insurance after the fact, right? After the fire happened or after a car accident happened, you can't buy insurance after the fact. So that's the definition of it, is you're insuring what could happen. Hopefully you never have to use it, but it's there for your protection if you need to. The other side of the other part of insurance is you have life insurance. Now, with life insurance, there's a couple different types of life insurance, and you probably have some life insurance that are offered from your employer as well. Those are term policies. I'm going to talk about perm and permanent here in a minute. And they're okay. They're extremely inexpensive, but you can't carry them with you. Once you leave your job, that policy goes away, or they'll give you a conversion option, and those conversion options are extremely expensive once you break away from the group. Sure, take advantage of those life insurance policies that work as an add-on, as a supplement to your life insurance, right? But they're probably not going to be sufficient for your overall need, right? There's calculations to go how much life insurance you need. Generally, the rule of thumb is 10 to 12 times of what you make annually is how much your policy should be worth. Now that could vary. That's just a rule of thumb. That can vary. You have to go into kind of a calculation or a swag on what you should have. It also depends on what stage of life you're in, right? I mean, if you're young and you got college kids, you got college ahead of them, there's a lot of different things. You're saving up for a house, those kind of things. It depends on what stage of life you're in, as far much you're going to need, how much you're making. But when you're going into how much life insurance you need, you want to have more than just the basics, right? As far as just covering final expenses, which is funeral expenses, those kind of things, because then you're not leaving anything to take care of your estate and your with your family. And heaven forbid, if something happens to you, if you're the breadwinner in the family, you're the one bringing in income. What are they going to do after the fact? They have to have that income replaced, and you're going to leave your family suffering if they're not able to pick up that income otherwise, right? So you can also get into the human capital, the value of human capital. Well, what is that? How can you put a price on life? You can't. But the human capital side of that is, what are you making a year? What are you contributing to your family? We're not talking about, how much is it worth for your love for your family, how much you provide for, love and support and encouragement, and those kind of things. You can't put prices on those things, and family is invaluable, but you can put a price on how much your money you're bringing into the family and how you're supporting that family, right? So you got to get the right amounts. So there's two different types. Well, there's more than two different types, but the main two types of insurance, life insurance, is you have term and you have permanent. And then there, outside of permanent or inside of permanent, there's different types of permanent insurance. Okay. So term insurance is where you buy, like, say, a 20-year or 30-year policy at a standard, at a set value, face value. Say you buy $1 million worth of life insurance and it's X amount of dollars a month, and you pay that for those 30 years or 20 years, however long the policy is that you took out, and then it goes away. And then when you go to renew it, you have to reapply, re-go through underwriting, redo the health test, and all those kind of things. And it's, term insurance is extremely cheap, especially if you get it when you're young. But say you're 25 years old and you get a 20-year policy, and when you go to turn 45 and you go to renew that thing, you got to go through underwriting, you got to go through your health thing, and term insurance gets more expensive as you get older. So when you're hitting, in your late 40s, 50s, 60s, and you go to try to get a term life insurance policy, it's going to be extremely, extremely expensive. A lot of times cost prohibitive to even get it. So people just go do away with it, and then their family's stuck kind of holding the bag there. The other side of that is permanent life insurance, which has cash values. It grows in value, and you have guarantees in there as well. Out of the permanent insurance, the one I like the most is universal life insurance, because not only does it cover your assets, and it covers income for your family. If you had passed away, they get a payout, but it also builds up a cash value that you can use later on, and you can take that money out as a drawdown and actually use in retirement. So it's a great tool to go along with a couple other aspects. It's just one of the flags in the arsenal for how to take care of different types of buckets in retirement that we talked about. But it's a great way for tax deferred. You have your protection at the same time as growing value, and that's earning money and growing as you go along. And that policy, the reason they call it permanent, is that it doesn't go away. You do not have to reapply. You do not have to go through re-underwriting. Now, those policies are more expensive. However, part of it goes toward the premium, but the reason it's more expensive, the other part of it goes to cash value, and then you have rights to that value. Some people call it infinity bank, and there's a lot of wealthy people that take out lots and lots of different permanent life insurance because they build up the cash value, and they become their own banker because their value is built up into that policy. And if they want to go buy a car or they need a loan, they go to the bank. They just borrow that from themselves out of the policy, and then they can pay it back at a much, much lower rate than what you could do from a bank. Now, not everybody's going to be able to afford 100% coverage to cover all their needs from a permanent life insurance, because, like I said, it can be expensive. Well worth it because of the utility and how it can be used for your retirement and for emergencies and whatnot down the road. But if you can't afford, say you need $1 million or $2 million worth of permanent life insurance or total coverage in life insurance, and you can't afford the premium that's on a permanent life of that large, then you can break it up. You can use part of it in universal life, which is permanent, and then supplement that with a term for to cover the difference. If whatever you can't afford on the permanent side, take it out on the term side. Work with an agent that understands all this, that can put you together a hybrid plan. And that term insurance, you can get it as a longer term plan on when you could probably afford to have that drop off based on when your needs for the premium would die down. So in other words, have your universal life in there, build the cash value, and then when you get up to retirement age, you could probably stage it to where that term then falls off, because you probably don't need quite as much life insurance at that point because you're retired, but you still need some to cover expenses for your loved ones. But the term could fall off and the permanent could stay in place, and you still have that cash value to draw down on. Okay. So great. There's some great strategies there. There's some great different types of policies. There's riders and stuff that you can put on there. Well, another thing to think about on the universal life or the permanent side is you can use that for long-term care, right? Long-term care. That's another type of insurance, right? Long-term care insurance is for when you get older and you're having to go into, if you have to go into nursing home or have home in care, those kind of things. Nursing homes and assisted livings are very, very expensive. For nursing homes, you're talking a minimum of about $6,000 a month. And that's not even for a private room. You're talking more than that if you want a private room. That can eat through your retirement very, very, very quickly. So part of your plan is you got to plan, what am I going to do for long-term care? So the long-term care policies out there, there's a good balance of when you want to purchase those. You don't want to purchase them too young. You don't want to purchase them too late, because if you wait too late, they're going to be a little bit of expensive. So, and there's different values on those it's called LTC, long-term care policies, that you can buy. As far as how long they last, what kind of coverages there are, the premium, how much you want to spend there, and how much value is in there. And so you can do a balance. You can take out a long-term care policy. If you have a universal or permanent life insurance policy, you could use some of those funds to help pay for long-term care. You can put riders on that. So there's a lot of different moving parts to all this. As you can tell, there's a lot of different insurance, there's a lot of different type of policies, a lot of different ways to strategize. So you got to sit down, work with a good agent that's there for you, not a 1-800 number that's someone over the phone trying to sell you a policy. A local agent that knows the inside and outs is going to give you some white glove treatment. Sit down, figure out a plan that fits you and your family, because it's not a one size fits all, right? You got to analyze your situation and do what's right for you. You don't want to pay too much. You don't want to get over coverages. You want to get what's right for your family, right? But all those are drastically important. Protect your assets so you don't get stuck diving into your emergency funds, going into debt, stressing out your family. And on the life insurance side, that's really, it's kind of, a lot of people call that a love policy. It's or a love card. It's because if you love your family, you want to protect your family, and heaven forbid anything happens to you, you want them to be able to carry on without getting into financial stresses and strains there. So that's an act of love. And if you have any questions around any of these kind of things, or any of the policies or types of policies, or if you want any kind of analysis, I'm definitely here to help. Hit me up on Facebook. Give me a Facebook message. Here, I'm going to put my calendar link up on here. I'll put it in the comment section of the post too. You can schedule an appointment with me. I'm happy to go over this or anything that we've covered so far in our sessions. Like I said, I want you guys to be educated, make the right choices, and do what's right for you and do what's right for your family. And I want to end with tonight. I know that's kind of a high level. That's what it is, 101. I want to make sure you're covered across the board. But I still want to go back to this key saying, as we're talking about financials here for our families, is that when it comes to money, we either worship with your wealth or worship with our wealth, right? Are you worshiping wealth, or are you worshiping with your wealth? Are you glorifying God in all that you do, right? Or are you worshiping wealth and trying to gain everything up for you and keeping up with the Joneses, right? So take that to heart. I hope you can keep that in the back of your mind. And like I said, insurance, not everybody thinks of that as a financial piece, but it is, because it has a huge financial impact if you don't have it at all, or you don't have the right coverages, right? And the one last thing I'm going to say to kind of wrap it all together, and I save it for the end, is the umbrella policy, right? The umbrella policy, most people don't think about this. The umbrella policy is just that. It's an umbrella that sits over the rest of your policies that then covers anything that those don't. So for instance, I talked earlier about if your auto insurance doesn't have the right liability limits or property damage limits, or even if it has a significant amount, but something catastrophic happens and you get sued, can you afford to get sued and dish out your life savings and everything you saved up for retirement, or your kids' college funds or wedding funds or whatever it may be? Umbrella then comes in and it kicks in when your limits are hit on whether it's your homeowners, your auto policies. That umbrella kicks in and then pays out above and beyond that. And I'm telling you, umbrella policies are extremely, extremely cheap. Now, it depends on how much you're covering, your house, how many cars, if you have youthful drivers, those kind of things will all factor into it. But I'm talking just a couple $100 a month can give you $1 million umbrella policy, well worth the investment to protect you in case you get sued. This whole thing is about protection. You got to protect your assets. You got to protect your money. You got to protect your family. You got to protect you so you can grow your family fortune, right? So you can get to that financial center there of financial freedom. Because if you get hit with some kind of disaster and you don't have the right insurance in place, it could set you back really, really far on the financial side of things. We don't want that to happen. So if you need any advice, you need to have any questions or whatever, please feel free to hit me up. Hope you guys found this helpful. Hit me up with a hashtag live or hashtag replay, depending on how you're watching it. If you have any questions, let me know. Next week, we'll get back into some investment and retirement topics. Until then, y'all have a great week, and we'll see you later.